We went from 24 units to 2,400 units, and here's how. Hey guys, my name's Ariane and this is my better half Chris. We're actually at the tail end of our series on how we retired at the age of 27. So if you watch our previous videos, you'll know that we bought a 24-unit apartment complex at the age of 27, and we pretty much renovated that, got the rents up, and then had $10,000 a month in passive income, which is all we needed to never have to work ever again and live happily ever after. So that happened, but life didn't stop there. Obviously, we kept on living and we kept wanting to invest. So now we're going to talk about how we actually went from that first 24 units to now we co-own over 2,400 units with partner investors.
Yep, so buying that first 24 unit, yes, it got us our freedom. It was much more passive than flipping a bunch of houses, which we did before. The downside is we were still pretty active. It was still a lot of work. It was a lot of work to find the deal in the first place and then close the deal. That was a lot of work. So we started thinking about how can we do this with a lot less work where we still get the benefits without having to be the one actively involved. So what we discovered was this thing called syndications where we write a check and then we get checks. That's it. We sign our name, we wire money, we start getting paid. And not only do we get paid, we still get paid in all four ways that you still make money in real estate, which are cash flow, which is what everybody thinks about. When the rent comes in, we get a piece of that. Appreciation, if the value of the property goes up, we have a piece of that as our net worth. Tax benefits, that income that we are receiving from the property is tax advantage because the government is trying to incentivize us to provide housing to the masses. And the last one is leverage, where we're able to get a loan on a property and have our tenants pay down that debt for us over time. So again, investing in a syndication, we are the passive partners, as the limited partners they're sometimes called, where we're basically just money. We write a check and then we get paid later.
Now, even as we were investing passively in syndications, we were still keeping an eye out for good deals in our local area. So after that 24 unit, we ended up buying a 3 unit and then another 22 unit. Then we also bought a second home that ended up being a vacation rental. So we still kept buying those active deals, right? That turned into recurring passive income-ish. When you're buying your own deals, it never is completely passive. We're usually just running the business and then we pay other people to run the business for us. And that's how it becomes semi-passive for us, but still not really.
As passive as it can get while actively running the deal. Yes.
Right, and that's why we invested as LPs, because that was pure passive, which was awesome. Now, as we were buying these 22 units, 24 units, we realized that eventually we would want to buy bigger deals. So we actually got in touch with the people we were investing as limited partners with and became co-general partners with them.
For general partner, for the people who are new to this, it just means the people who are active, the people who are running the day-to-day management of the deal. So instead of us being completely passive, we started taking active roles so that we could join the general partnership and build a track record so that when we wanted to do this on our own, we would have the track record to prove it.
So then this happened for a year or two, and then as we started getting our cash flow from the limited partner deals, we were like pretty happy about that.
And then suddenly the cash flow stopped. What's going on?
Where did it go? Where is it?
Oh, they sold the property. That was not the plan. I wanted cash flow. As an LP, we don't really get a choice. When the general partners decide it's time to sell the property, the limited partners are along for the ride. We're passive in the deal. So regardless to whether or not we wanted to keep that cash flow, we were happy with that cash flow, we weren't in control. And that was one of the trade-offs. When you're investing passively, you give up control in exchange for the passiveness.
And if you remember, we already flipped 500 houses. The only reason we started investing in multifamily was because we wanted to stop flipping things. And now we realize that, oh wait,
apartment buildings.
All these syndicators typically are flipping apartment buildings, and they're just not flipping them in 3 months like we used to flip houses. They would flip them in 3 to 5 years. And the other thing too, we actually really like the tax benefits when you buy apartment buildings. We were using that a lot to offset our taxes. So when you sell, you actually have to pay those taxes back, which was again not very good for our purposes. We wanted cash flow and long-term tax benefits, not just tax benefits for a year or two. And with syndications where most of the other syndications run it as a flip, well, we didn't get the two main things we wanted the investment for.
So again, we decided we're not going to flip apartment buildings. That is not what we're looking for. We're looking for the forever money that we talked about last time. Flipping apartment buildings is just another job. It's just another transactional thing. All right, so how are we going to do this? The only way we saw at the time was we're just going to have to do it ourselves. So we're going to build a different model that allows us to keep these properties forever. So it's still a syndication. We're still raising money. We're still partnering with other investors to buy a very large deal. But instead of selling it in 3 to 5 years, we're going to use the same strategy we used for our first 24 unit and aim for a refinance instead.
The model we use for our syndications, and we really created it for us, right? Our primary purpose is long-term cash flow, long-term equity growth, long-term tax benefits, and we wanted that forever money instead
Not for a
of
few years.
a few years money. So what we essentially did is the Burr method for multifamily, right? And we just do it through syndication. So what we do is we look for deals. When we find the deal, it has to fit into that Burr model where it would be possible to refinance all the cash invested out in the first 3 years or so. We essentially invest for cash flow. We refinance all the money out, and then we still cash flow a smaller amount after the money's out, but there's no more risk.
Yep, so once we refinance, we take the risk off the table because everybody's got their initial capital back, and then we basically cash flow free money for the rest of the duration, which for us is, I don't know, 20 years. We're getting much longer than 3.
Yeah, and it's an infinite cash on cash return because there's no more money left in the deal. They just get money infinitely. And the good thing is, if the market goes really, really well, then that increases, right? Their cash flow increases, the equity increases, tax benefits, we don't have to repay our taxes. And we actually plan on keeping this for as long as possible. And if we do have to sell, we are planning on doing a 1031 exchange into a next bigger apartment building, which means that us and our investors don't have to pay taxes either, right? Because we're not actually selling the normal way.
We don't have to recapture until the final sale, because we're 1031ing the property into the next property.
So there we have it. That's how we went from 24 units to now co-owning 2,400 units with partner investors. Now, not all of those 2,400 units are in this long-term model, because remember, we kind of did the sell every 3 to 5 years model in the beginning, but we are working on transitioning all of those into that long-term model because we want forever cash flow, forever equity, and forever tax benefits, not one-time cash flow, one-time equity, and one-time tax benefits. All right, guys, if you want to watch more of these, we have a lot of syndication specific videos. We actually have a playlist. I'll put that up here and in the description below. And we have so much more videos on how to get to financial freedom so that you can be financially free as well. Please check out the other playlists on this channel. We also have a free Facebook group called Faster Financial Freedom, where you can ask questions and network with other people who are on the path to financial freedom. And click that subscribe button and notification bell and the like button for the YouTube algorithm. All right, guys, thank you so much, and we will see you next time.